Hi everyone, I am very happy to welcome you all to Dr. JJ's Virtual Academy of Commerce. In this video, I am going to deliver a lecture on the topic Tools and Techniques of Management Accounting. These are all a couple of details related to me. After you watch the full video, if you find the video useful to you, give a like to the video. Kindly subscribe my channel and enable the notification so that you will get the notifications of my new videos on accounting and marketing subjects. Let's get into the topic, Tools and Techniques of Management Accounting. Management accounting, to fulfill its primary purpose of providing valuable information to the management for effective decision making, it makes use of a few tools and techniques. We are going to discuss about a list of 15 tools and techniques of management accounting in this video. Number 1, financial planning. What is the meaning of financial planning? It is a process of determining the future requirements of capital after taking stock of the available resources. The main objective of any business organization is maximization of profits. This objective is achieved by making proper or sound financial planning. Management accounting makes use of the financial planning technique and its outcome for preparing valuable report which will aid the management of a business organization in effective decision making. Therefore, financial planning is the best tool for achieving the business objective of maximization of profit. The second technique is nothing but financial statement analysis. The financial statements are analyzed for different periods. This type of analysis helps the management to know the rate of growth of a business concern. This analysis is also done through comparative financial statement analysis, common size statements analysis, and also ratio analysis. Through these analyses over the financial statements, the management accountants bring out useful information which could be incorporated in their reports, and the same will be submitted to the management for effective decision making. The third tool of management accounting is cost accounting. Cost accounting presents cost data in product wise, process wise, department wise, branch wise, and the like. These cost data are compared with predetermined one. This comparison enables the management to decide the reasons that are responsible for the deviations or the difference between the standards and the actuals we have measured. The fourth tool of management accounting is funds flow analysis. This analysis is very useful to know whether the fund is properly used or not in a year when compared to the previous year. The working capital changes, the funds from operations or funds out of operations are also found through this particular analysis, which is a very popular tool being made use by management accountants specifically in India. The fifth tool of management accounting is cash flow analysis. The cash flow analysis prepared as per Indian Accounting Standard 3 or International Accounting Standard 7. It analyzes the inflow and outflow of cash and changes in cash position of a business enterprise for a given period. It studies the flow of cash from operating activities, investing activities, and financing activities for a given period. This is again a very important tool of management accounting that facilitates the management accountants to come up with meaningful insights with regard to inflow and outflow of cash through these three categories of activities, which will enable the management to clearly understand the flow of cash into the organization and as well as out of the organization. Eventually, they are enabled to take meaningful decisions on different functional areas. The next tool of management accounting is standard costing. Standard costing provides a yardstick for measuring actual performance, and the same is compared with the corresponding standards with regard to material, labor, overhead, and sales. It also finds out the reasons for the deviations, if any. If the deviations are positive, the people are the centers which are responsible for the positive deviations. They will be rewarded and recognized. If the deviations are negative, the management can very well carry out control measures to correct the deviations which are of negative and direct the people concerned towards the right path. The seventh tool of management accounting is marginal costing. It is used to fix the selling price, selection of the best sales mix, best use of scarce raw material or resources, to take decision of make or buy a component, acceptance or rejection of a bulk order or a foreign order, and the like. Quite a lot of managerial decision makings could be done by the management with the support of the data derived or the information derived from the marginal costing technique. The eighth tool of management accounting is budgetary control. Under budgetary control technique, future financial needs are estimated and arranged according to an orderly basis. It is used to control the financial performances of a concern. Business operations are directed in a desired direction using the tool of budgetary control. Since budgets are planned well in advance for the future, definitely it gives a clear direction to the employees or the managers of a business organization to know the path they have to take towards the fulfillment of an organization's objectives. The ninth tool of management accounting is revaluation accounting. The fixed assets are revalued as per the revaluation accounting method so that the capital is properly represented with the assets value. It helps to find out the fair return on capital employed. The 10th tool of management accounting is decision making technique. Businesses are complex in general. It requires assessing various factors or variables and circumstances before any financial decisions for the organization are taken. There can be several alternatives in front of the management. Decision-making techniques help the organization and the managers in choosing the best alternative decision. Various tools of management accounting such as differential costing, capital budgeting, marginal costing, relevant costing are used to select the favorable alternative to maximize the profit of the business. The 11th tool of management accounting is MIS, Management Information System. The free flow of communication within an organization is essential for effective functioning of the organization. Hence, the management can design the system through which every member of the organization can access the information and use for discharging the duties and taking quality decisions. The 12th tool of management accounting is statistical techniques. There are a lot of statistical techniques starting from the measures of central tendency, standard deviation, correlation, regression, drawing diagrams, charts, and the like in removing the management problems. Methods of least square, regression, and quality control, etc. are the popular tools which are widely used by management accountants in preparing their reports, which will definitely enlighten the managers and finally support their decision making. The 13th tool of management accounting is management reporting. The management accountant prepares and submits various reports based on the requirements of the management. Such reports disclose the strength and weakness in different areas of operating activities, investing activities, and financing activities of the business enterprise. This identification is highly useful to the management for exercising control and also taking effective decisions. The 14th tool of management accounting is communication techniques. The managers must receive the right information at the right time so that they can take correct decisions at the correct time. This will allow them to carry out the functions of decision making, planning, and control effectively. Free flow of communication is a must for better functioning of an organization. The 15th tool of management accounting is taxation. Management accountants make use of the tax provisions for preparing meaningful reports stating the implications of such provisions on the profitability and also on the financial position of the business enterprise. I hope I have done my lecture up to your level of satisfaction. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.